If you are thinking of buying or selling a home near Glendora, I'm going to give you a quick market update for the real estate market and talk to you about what we have been seeing and what we're looking out for going forward for both buyers and sellers. Okay, so our first graph is the days on market. That shows you that as a whole, Glendora's days on market have been decreasing, which means properties have been selling quicker than they have in the past. That's good news. I also see from this particular graph, the blue line tends to lag the red line. The blue line is Glendora. The red line is everywhere else in the greater Los Angeles market, or Southern California market to be more accurate. So I see that the greater Los Angeles or Southern California market, days on market, this red line has begun to taper off and straighten out. And I'm expecting it to begin to increase as it has in the past towards the end of the year. So I'm expecting a similar trend in Glendora, unless a bunch of people with insurance money from Altadena start buying up houses in Glendora. That might change, I'm not sure, but I am seeing typically Glendora lags the greater market a little bit, this blue line peaking slightly after the red line in these scenarios. So that's days on market. Currently they're good, which is low. Low is good. Months of supply, I am seeing months of supply increasing with the red line, which is the Southern California market in general, and now slightly later began to increase in Glendora. As I mentioned previously, we tend to lag ever so slightly. That's not good or bad. It's just an interesting thing to notice. And now the price per square foot, I would say, looks pretty stable to me. It's pretty much up and to the right here for the last few years. And the last couple months is kind of hovering around this mark. I will say that it seems like we're not quite creating a new high. It seems like we might be hitting a little bit of a barrier based on last year's high. So to me, this feels close to the top for the year. Not calling doomsday, I'm just saying within the year we have cyclical effects, which you would know if you've been following along all my previous market update videos. Lastly, I will talk about interest rates for a moment. We are hovering around 7% right here. This graph shows you the last 5 years of interest rates, you know, the artificially low rates in COVID, and then boom, now we're up here hovering between 6 and 8, and now 6 and 7. And from my perspective, I have been noticing a natural resistance around 7. Once it goes over 7, like it did back in October 2023, the market just hit the brakes hard. And when it hit the brakes hard, mortgage applications plummeted. And when mortgage applications plummeted, then rates started coming down. And when they came down below 7, everybody hit the gas again and mortgage rates shot through the roof. And boom, demand picked up. And when demand picked up, rates went back up again over 7. When they went back over 7, demand slowed down again and interest rates came down close to 6. This time, boom, stepping on the gas again, and rates jumped back up to 7. And right now we're hovering around 7. I do think there's a little bit of a natural channel between 6 and 7% right now. When it goes over 7, I think people really start to rethink their choices. When it goes below 7, people get really excited. That's been my experience in the last couple years. So with that said, Trump has been trying to lower rates for a long time. Ever since he took office, he promised this and that. The reason is because the United States Treasury has a lot of debt outstanding that needs to roll over, and they don't want to roll over into high rates. So they were trying to bring the rates down, and they were trying to do that with a multitude of different ways. However, recently, trade wars and tariff wars have not gone as Trump had hoped. And Doji has not been as successful at reducing government costs as he had hoped because it requires congressional approval. Now, I'm sure they're doing some good, but also not going as smooth as they had hoped. And therefore, the United States debt continues to climb. And because of that, Moody's, which is one of the big credit rating agencies, Moody's and the S&P, Standard & Poor's, they reduced the United States credit rating from AAA to AA1. I don't know if that's called AA or AA1 or whatever. Long story short, AAA used to be the highest credit rating available out of their 21-notch credit rating scale. Now they've dropped us down a notch, so now we're 20th from the top of their scale. Now, it's not doomsday. However, because of this situation, because of our growing debt at the United States Treasury level, at the recent bond auctions, which is when investors can buy United States bonds, the auctions were not as strong as people were hoping. And so bond investors required a higher yield. on their investment. And because they required a higher yield on investment, they're requiring a higher yield because the United States credit rating went down. That's the reason. If you lend money to someone with great credit, you might give them better terms, similar to when you apply for a mortgage. If you have perfect credit and this and that, you get the best rate. If you lend money to somebody who has lower credit, you might demand higher returns to compensate for the higher risk. So now the United States Treasury, when their credit rating went down a notch, became a higher risk to investors. So investors want a higher return on the higher risk, which comes in the form of a weaker bond auction. Now, when the weaker bond auction happens and the yields demanded are higher, now the 10-year Treasury yield is higher, which the mortgage rates are typically priced on the 10-year Treasury, so therefore mortgage rates went up. So with all that said, rates did not come down as much as we had hoped because US debt is higher, so Treasury yields are higher, so mortgage rates are higher, but I do see them hovering around the 7 mark, and that's, like I said, because I think there's a natural resistance at the 7, and lenders might have to squeeze their margins a little bit just to make mortgages go through, because lenders need to make mortgages happen in order to survive. So I hope this was helpful for you. If you're a buyer in this market, keep an eye on rates. We're happy to keep you updated. Mortgage News Daily is a great website for that. And just know that when things go below 7, I've seen it get very competitive. When they go over 7, it seems to slow down. Maybe that's an opportunity for you. Maybe you grab a deal when it's over 7, when everybody else is out of the market, and then you refinance when it's below 7, when everybody else is in the market. That's up to you. If you want to bounce your ideas off of me, please feel free to call me. I'm happy to chat about it. Also, sellers, keep an eye on rates, because when rates are over 7, the offers slow down. And when they're under 7, they speed up. So that definitely affects you. Now, we have a couple tips and tricks to help in this scenario. If you're a buyer or a seller, if you're a buyer, we do have a $20,000 grant with no PMI and no strings attached, which is fantastic, free money. So let us know where you're thinking of buying, and we'll let you know if those areas have good opportunities with this grant. And if you're a seller, let us know where you live, and we will look up that area and see if your home might qualify for the grant, which will help us position the property and market it more effectively and help you get better offers from buyers that are more eager to purchase because they got free money on the line. I hope this was helpful. Please let me know your thoughts below. Feel free to share this or save it if it's helpful for you, and let me know what other questions you might have. God bless you. Talk to you soon.